Most investors believe cheap stock create wealth, but Warren Buffett himself proved that this thinking is incomplete. And the businesses that changed his entire investing philosophy was See's Candies. If you understand this one case study deeply, we'll stop looking only for cheap businesses and start identifying powerful businesses that can compound for decades. This video is only for educational purpose, not investment advice. And if you want to learn serious investing, not random tips, make sure you subscribe to the channel and like this video because we are building a community that understand value businesses, quality and long-term wealth creation. Now let's understand the story. In 1972, Buffett and Charlie Munger bought See's Candy for around $25 million. At the same time, the tangible asset of the business were much lower than the purchase price. So from a traditional value investing perspective, it looked expensive. Buffett was trained by Benjamin Graham to buy cheap asset, but See's Candy forced him to think differently. He realized that he was not only buying factories, inventory, or a physical asset, he was buying pricing power, customer loyalty, and emotional demand. See's Candies was not just selling chocolate, it was selling gifts, memories, holidays, relationship, and trust. And when a product becomes emotionally connected with customer, price sensitivity reduces. That means the business can increase prices without losing demand. Here is what most people miss. When a business has real pricing power, it does not need explosive growth to create wealth. It needs consistency, discipline, and capital efficiency. After Berkshire bought See's Candy, the company generated more than $2 billion in pre tax earning over time, while requiring very little additional capital. This is the real magic. Buffett paid around $25 million, but the business kept producing cash for decades. That cash could then be used by Berkshire to fund other investment, which created a compounding chain. This is why See's Candy became more than an investment. It became a lesson. Before this, Buffett focused heavily on cheap valuation and asset bargain. After See's investment, he understood that a wonderful businesses at a fair price can be much better than a fair businesses at a wonderful price. Now let's break the lesson properly. First, C's had a pricing power. Customers were loyal and because they associated the product with emotion and occasion, they were willing to pay more. Second, C's had a brand strength. In its core market, people trusted the brand and kept returning. Third, C's had a capital efficiency. It did not need huge reinvestment every year to produce cash. This combination of pricing power, brand trust, and low reinvestment requirement created exceptional return. Now apply this to your investing. Many investors only look at low PE, low prices or cheap valuation. But a cheap business can stay cheap for years if its economics are weak. If the company cannot raise prices, if customers are not loyal, if margins are weak, and if growth needs constant heavy capital, then valuation alone cannot protect you. The Seas Candies lesson in that quality matter deeply. Before investing, ask, can this company increase price without losing customer? Does it have emotional or behavioral loyalty? Does it generate real cash? And does it need heavy capital to grow? If the answer is strong, then you may be looking at a compounding business. If the answer is weak, then cheap valuation may be a trap. Buffett's biggest shift was not from bad investing to good investing. It is from a statistical cheapness to business quality. And that is the real lesson. Cheapness is temporary, but business quality is durable. Once you understand this, you stop asking only whether the stock is cheap and you start asking whether the business is powerful. That is how Buffett's investing philosophy changed forever. And that is how serious investors should think. Make sure you subscribe the channel. See you in the next video. Thank you very much.